Well, hello, and thank you for joining me here online today. I am pleased to be able to introduce to you all a good friend, confidant, and frankly, a mentor figure by the name of Tim Rose, with decades of experience that will be our primary focus for the day. I'm going to ask Tim to introduce himself and ask some questions along the way that will hopefully give some guidance in the context of when thinking about investment. How does portfolio management play a role in helping guide an investor towards the appropriate allocations? So if we can start with this way, Tim, tell us a little bit. So Tim Rose and Associates, it sounds like it's a firm pretty close to you. How did you get involved in investment advisement?
Well, Al, that's a good question. Back when I was a young kid, it's probably around 8 years old, I came to my father and I said, Dad, we need to buy some Chrysler stock. Because at that time, Lee Iacocca had just taken over the firm and he was going to take that company over and bring it literally out of the toilet. And he did. History reflects that. And I told my dad to buy that stock. And I was always following business and so on, and I thought it was a good opportunity for him. He never did buy it, but the stock did quite well as a result of the new management and the new approach, cars, products, services. And I've been interested ever since.
So having done it for as long as you have, what are some of the favorite parts of your job? What excites you when you wake up in the morning?
Well, that's another great question. I'm very fortunate and blessed to have an opportunity to make an income. That's something that I have a passion for. So the base of my business is information, and it's public information, but perhaps it's a different way of approaching that understanding of the information. So my job revolves around reading, watching various TV programs and videos, thinking, playing out game theory, and deciding whether or not this business from a quantitative and a qualitative basis would make a good investment or not.
So reading, watching, thinking, what are some of your favorite sources? What do you like to read, or where do you go when you want to think, or what are you watching to keep you informed?
Well, I start each morning with the Wall Street Journal. I start every Saturday morning with the Barron's, which is another investment journal. Throughout the day, I get news feeds on my screen of up-to-date events that are happening throughout the day, which may be market moving, may be pertinent to the stocks in my portfolio or the bonds in my portfolio. And I watch CNBC. I watch TD Ameritrade, which is a show that focuses mostly on options and option strategies. And I'm constantly looking at various news feeds. I may read anywhere from 3 to 4 newspapers per day online.
You're not, I noticed Mad Money with Cramer not anywhere on that list. You're not into the entertainment component of investments?
Yeah, Jim is an interesting guy. And yeah, from what I understand, he's done well. And every once in a while, he has some pretty good ideas. But usually, I don't make that a regular part of my day to watch Jim Cramer.
Well, he also has a wonderful assortment of funny noises as well that he's accumulated. But we are in a time where your role, one would presume, is beset by stresses as a result of uncertainties in the market. What are the parts of your job that keep you awake at night?
Well, the biggest one, Al, is the unknown knowns. You know, what have I missed? What did I not think through fully enough? For instance, in this latest market crash, this black swan with this global pandemic and how it affected the markets, and in my portfolios, we hedge at certain points in market cycles, and certainly we were hedged. And however, I started to take the hedges off a lot of my portfolios at a certain point, but then something happened which had never happened before, a true black swan. And that's the government actually shutting down business. Never seen that one before. And of course, the fallout is what everybody knows, the market going down about 35% from year to date. And of course, from where I was, even more than that, because I had been up substantially prior to that happening.
So in the midst of this, one would presume that the people for whom you are a fiduciary in managing their money probably have their emotions and fears running high as well. How do you work with your clients and investors to give them perspective or possibly even hope during a time like this?
That's a good question, Al. Most of my clients have been with me for years, some for decades. And over the decades, I've hopefully educated them on what the market does. Market over time in capitalism goes up in a very jagged line, but it always goes up because of the invisible hand, the animal spirits, the innovation, people thinking of new ways to do things better. So looking at a long-term scenario, looking at a long-term cycle, people need to, for the most part, if they aren't good at it themselves, just when they don't know what to do, do nothing. Go spend some time with your family. Go out to dinner. If they're invested well, a year from now, it'll all be okay.
Mm. So you mentioned that many of your clients have been with you for a significant amount of time. Reflect back on the early days of establishing relationships with clients. What did you use as your primary strategies to build a book, develop trust, and get to the position that you are now? What were some of your key tactics that helped you to build that confidence?
Trust is the number one factor in a great client advisor relationship. You might have seen the statistic recently that clients typically, I think about 35 or 37% trust their various advisors. So you can imagine that if somebody's investing money, most of them don't trust their advisors implicitly, which is pretty interesting. The way I got or built my trust over the years, first you want to have a relationship with your client, and then it's a process of active listening, understanding who they are and what their objectives are, and making sure they understand that you understand where they're coming from and where they want to go. And then it's a process of under promising and over delivering over time and doing what you said you're going to do.
So do you use any tools or other mechanisms to help build that relationship, to define that trust, to get to understand things about your clients, or is it just a natural relationship development process that you employ?
It's more of a natural relationship, Al. I've been in this business a long time, and technology has increased tremendously. And it used to be, well, they told you need to, when I worked at other firms, you need to call your client every month or every week, or mail them something. Always have your name in front of them. Mm-hmm. Well, at this point, you have to understand some clients don't want to be contacted at all. And other clients do want a phone call, but perhaps they don't want to talk about their investment portfolio. Maybe they want to talk about curling. Mm-hmm. It's December in Minnesota, and that's their passion. And they just want to hear from Tim and hear that he's thinking of them.
Mm-hmm. So do you keep a database with notes about this client likes curling and that one prefers curly fries, or is this just something that you have a natural affinity towards remembering?
Well, I wish my memory was that good, but it's not. So after each phone call, I jot down information and I put it in a client relationship database. Mm-hmm. So early on in a relationship, I will put that in front of me and read it prior to me making that phone call and making that connection again. If I have to call Mrs. Anderson about a particular issue, so I know how many kids she has and what she calls her dog and that sort of thing.
So in the midst of that, one would presume that in representing a client in their best interest, there's a degree of determining risk tolerance.
Absolutely.
Is that a tool that you use, or is there a questionnaire, or is it just something you have a feel for determining what a client might be able to tolerate?
All three, Al. As I mentioned before, there's very sophisticated technology to determine risk parameters, and as a money manager, Sharpe ratios and all these different formulas. Well, the average person doesn't know what any of that means and doesn't really care to know how to calculate a Sharpe ratio or something like that. Now, when I talk to my institutional clients, it's a whole different matter. But the average retail client or individual client, they may think they have a great risk tolerance, but they may not actually have a risk tolerance. So you really have to communicate effectively on a quantitative and qualitative basis If you have $1 million, for instance, and you lose 100,000, what will that do to you emotionally?
Mm-hmm.
Versus, can you absorb a 10% loss?
Sure.
Maybe he doesn't really understand 10% is that 100,000, and you could have two different outcomes if you don't communicate that effectively.
Seems as if the world of investment advisory is an interesting meld of the technological, quantitative, and the emotional as well.
Definitely. Money is very emotional.
So let's say you have the opportunity to work with a new client for the first time. You've had some of your introductory conversations. You have a good sense of what their risk tolerance and some of their goals. Talk to me now about asset allocations. How does a portfolio manager think about the appropriate investment categories for an individual or an institution?
Well, for an institution, it's different typically than for the individual. For an institution, for instance, if they say, I want to put this part of our pension in a growth strategy, well, there's certain things that qualify a strategy to be a growth strategy, and a certain basket of stocks that you have to choose from. You can talk about growth, large cap or mid cap or small cap, or large cap rather, and it's mostly defined in a particular area, and then you play in that particular ballpark. With an individual, depending upon the individual, whether it be a 83-year-old widow or a 35-year-old multimillionaire entrepreneur with a very high risk tolerance. Mm-hmm. I have all those types of clients. So you build portfolios accordingly.
Mm-hmm. So some basic portfolio theory that seems to be commonly accepted is the somewhat 60-30-10 point of view. 60 equities, 30 fixed income, 10% alternatives. This course focuses on the 10% to some extent in terms of thinking that things are not necessarily pure equities or pure fixed income, but commercial real estate, which I know also rolls up into an equity category known as real estate investment trusts. What's your experience working as an advisor with real estate investment trusts? Have you had much in terms of positions in REITs over the years?
Well, first part of that question, back when I was an investment banker, I financed a number of well, first of all, we underwrote the bonds to finance the real estate, and the real estate went into REITs. I've done some commercial investing, and I also have had REIT investments. So when you do your due diligence on a REIT investment, whether it be a mortgage REIT or something along that line, you really have to dig into the underlying securities. Where are those investments located? How are they financed? What's the geographical location? How much debt is on the books? What kind of debt coverage? There's a lot of questions you really have to answer before you can determine if it's a good REIT. A lot of times when people buy these ETFs and REITs and so on, they think, well, geez, I'm getting exposure to a particular sector or something. And because I'm diversified, I'm safe. Well, that's not always the case, especially with REITs. I've seen many blow up over the years, and you probably have too, because not all REITs are created equal.
Mm-hmm. So you mentioned too that as part of your analysis, geography or the underlying composition of the assets in terms of what they are, what's their function, how they're financed, as well as where they're located is something that's critical. One of the things that we're focusing in on is how Chicago has a unique position in the marketplace, and we're trying to expand its understanding to some of our global partners. I know that you went to school in Chicago. I was wondering, though, have you had any particular key takeaways about investments in the Chicagoland marketplace, specifically as it relates to either real estate or commercial property or the other assets that define my town?
Al, I do have direct experience, but it was a long time ago. As an investment banker, I ran the office in Chicago for my New York investment banking company, not mine, I was a partner in it. And as a result, I did some municipal bond underwritings, which supported things like the O'Hare Airport, big infrastructure, of course, a soccer stadium. This is some years ago. In fact, I might even have the
got the loose site there
here. But we've done some of those projects, but from what I understand about Chicago these days, I would think because of the financial stresses in the hands of an individual that has great experience and knows which parts of Chicago represent opportunity and which parts may represent quicksand, there would be some great opportunities for a long-term investor.
Yeah, I think if we went to muni bonds together, we could probably still see some of those O'Hare bonds that are still live and not mature yet. So here we are, and we've just come onto the other side of the markets being open for the day. And I think today was another very volatile session. What's your outlook in the next 6 to 18 months in considering the known unknowns?
And there's a lot of great answers you see floating around, but a lot of it's contingent upon, of course, COVID-19, and if some of the experts' projections come true. Now, I know the mortality rate's just a fraction of what we thought it was initially, based on the information out of China. And we don't know if it's a seasonal thing. There's so many unknowns about it. But if in the one scenario that we do get a reoccurrence of it in the fall or next winter, the markets will, our VIX today was in the 30s. It'll spike. The VIX will spike back up. That's a volatility measure. Mm-hmm. The uncertainty will spike up again. The markets will, of course, go down. If we don't have a vaccine, all bets are off. We could, of course, the deaths could increase again. We could get some more spikes in the bell-shaped curve. And people might have to stay home again and shelter in place. I don't think in this country we'll have the herd immunity that Sweden is fast approaching. And a lot of people are doing the opposite. So if you're hiding inside with a mask on, you're actually reducing your immunity system. Mm-hmm. And if we come back out, as a lot of communities are, they're going to be exposed to something that their system perhaps aren't used to.
Yeah. So
that's one scenario. The other scenario is, okay, I've seen a lot of people flaunt the shutdowns and have dinner with their friends, and even, maybe they had 30 days of a shutdown. Now they say that's enough. And perhaps if a lot more of us have this virus than we thought initially, and perhaps our immunity levels are a little higher, and perhaps if the people we need to protect are the most vulnerable, the elderly, the obese, the people with pre-existing conditions, perhaps our economy, because of the $4 trillion in stimulus, and as you know, as an economist, 6 to 9 months before something happens, and you remember during quantitative easing, there was a 90% correlation between the S&P 500 rise and the quantitative easing. Mm-hmm. That's the scenario that I'm leaning towards and betting on. But of course, at the appropriate time, I'll be hedged accordingly in case this other scenario happens. And I hope it doesn't. Mm-hmm. But I think we could have a very exciting fourth quarter, possibly up, on the S&P in the 32 to possibly 34.
But I had always grown up believing in two somewhat disparate theories of the market. One being the random walk theory, and the other one being the idea that markets hate uncertainty.
Yes.
How do those two things factor into the world for you right now? Does it change the way you're allocating maturities? Are you more heavily invested in short bonds versus long? Or how does those factors of uncertainty really affect what you're doing in these uncertain times?
My firm manages large bond portfolios for institutions. And we met, and these guys use Skype. I almost said Zoom, but we had a Skype meeting the other day, and my bond manager, Dean, was on the call with me and some other folks. And we were talking about inflation and talking about interest rates and the possibility of negative interest rates. Mm-hmm. Because, of course, our Fed chairman said anything's possible. He sounded kind of like the Draghi prior to his, as he said, I'll do what's ever necessary. Which of course is comforting to the markets, but brings into the possibility, could we have negative interest rates here in the States, unprecedented? And what kind of possible outcomes could come out of that? So Dean and I had this discussion about covering that tail risk. Right now, our portfolio is in short duration agencies. Now we can beat our benchmark, which is the Treasury index, the 1 to 5 year Treasury index, because agencies, well, they have an implicit guarantee, a AAA rating, government backing, although it's not like a Treasury, but you can get away with it in government portfolios, which this is, and you get extra yield. And if it's a callable project, sorry to get kind of wonky, but there's an option on there that says, okay, the issuer can call it back, and there's a price for that, which is a higher yield. So we invest in callable agencies typically to beat our benchmark, because total return, of course, appreciation plus that yield, that dividend getting paid out, that income, quarterly income. But in the case of all of our bonds getting called away as interest rates go down, and us being sitting there with nowhere to invest if interest rates go below zero, let's cover that risk and get some capital appreciation and get a bullet that will, of course, go up if we get those negative interest rates, and it won't be called away. And we had to do the calculations to hopefully be a winner if that scenario took place. But on the other hand, if there's a surge of inflation, which a lot of people have been saying was going to happen for a long time because of quantitative easing, what happens in that other scenario if the interest rates spike and that zero coupon bullet just gets, massacred as interest rates spike. So anyway, that's how I think about bonds and bond portfolios. From the stock standpoint, of course, Mr. Bogle, the late Mr. Bogle of Vanguard, made a fortune for Vanguard. He didn't make all that money, but it was a great idea to, everything's known that can be known, and you really can't beat the index. Well, some people do, most people don't. But that goes back to your question about risk assessment and doing, perhaps, I'm a contrarian. When other people are throwing their hands up, running the other way, and the tide goes down, and like Warren Buffett said, you see who's wearing a bathing suit and who isn't. That's typically when I'm hopefully, even though my stomach is upset and I feel like I want to throw up, that's when I'm looking at the portfolios of stocks available and saying, well, this company is selling for half its book value. And assuming that we aren't all speaking Chinese, 5 years from now, it's going to be a good investment.
Might you take a moment for the lay viewer to explain what negative interest rates means?
Well, that's basically when the issuer, let's say the United States government, the Treasury, says, Al, you're scared. You're scared tremendously of getting a return of your capital. So much so, you don't want to go to a bank because you don't want that bank could fail. So you want a return of your principal. You want a return of the money that you have invested more than you want 1% interest. So what a lot of sovereign governments have done, mostly in Europe, haven't seen it here yet, have said, okay, we're going to issue some 100-year bonds or 50-year bonds or something to people who are just scared, ridiculously scared. And some pension funds, larger pension funds, buy those bonds because they have certain liability to various ratios they have to abide by.
To deploy.
And some individuals say, well, yeah, I'm scared. I'm hiding under my bed. I don't trust the bank. I'm going to put my $100,000 there too. So it's never happened here. Although we have seen, you remember during 0809 when the money market failed, which doesn't happen, just doesn't happen, but usually it's set to $1. But we had some negative interest rates. And if you look at the yield curve, sometimes you see some negatives during this last little stint. But from an issuing standpoint, the Treasury hasn't issued negative yielding bonds.
Well, I must say that we are living in unprecedented times. And while I'm not ready to hide under the bed and run scared from the markets, It is easy to be fearful right now. And so it is a comfort to me to know that savvy investors with lots of experience who've lived through these times have their fingers on the pulse of a longer term for which I can give my confidence in the short run and keep me from becoming too emotional about money. So with that in mind, Tim Rose, thank you so kindly for your
I,
time here today. I am very appreciative, as are the students who will benefit in learning about the investment advisory function. So thank you, Tim.
Thank you, Al.